All right, I think we are ready to start. Welcome everyone to the volunteer briefing call for the CFA Institute Research Challenge 2025. It's actually our 17th season, so most of you have already been participating for many years. However, this year it's a bit special. Out of the grader and mentor pool, we have 20% of new joiners. So thank you very much for joining this initiative and for helping the students and us to bring up the next generation of finance. We appreciate that it's Friday, 5 p.m., so we'll try to keep the introductions short. We will just go over a couple of basic things that we go over every single year, and then give the word to Mr. Patrick Rafais, who is with us in the call, who will present the subject company. So without further ado, the challenge is growing annually. Last year, it has seen 500 more students. Now the challenge involves over 6,700 students. The number of universities and local challenges is growing, and also we reach globally 100 countries. Great achievement. Last year, University of Poland was crowned as a global champion, but this year again, we will try our best to see Switzerland on the right. But yet again, last year, University of Neuchâtel did a great job and reached the global finals. So great job. And this year, we're still waiting for universities to confirm their participation. We expect, as always, 10 to 12 universities and close to 200 students to participate. Each student will be assembled in the team from 3 to 5 students and work on analyzing a subject company. And there are mainly two deliverables. First is the report of 10 pages, followed by the 10 pages of appendix. It has a very predefined structure. Each structure received a certain amount of points, and there are certain things to look over. So nothing has changed in that regard from previous years. Second deliverable is the presentation. That's the main, let's say, juice of the challenge, where students will work on presenting their story to the judges and then defending their analysis in a Q&A session. Again, there are no changes here in terms of how presentation is scored. Each team is supported by two people. First is the faculty advisor, mainly the person in the university who is organizing the challenge in the university. They have 10 effective, productive hours with the team. And they mainly focus on insight and guidance on how to research a company, how to do a model, and what is taught in academia. At the same time, each team is supported by an industry mentor. They have 6 productive hours with the team. They can meet either virtually or face-to-face, and this is more of a practical aspect of the challenge. Usually students ask very practical questions on how to tackle the research. They practice Q&A sessions. Mentors are asked to look over the report, to challenge the investment case, to review first draft of the presentation. In the relationship between the mentor and the team is in the driving seat. We keep repeating this every single year, so this one is a very important point. We will connect you after the kickoff, after the challenge launches officially on the 9th of October, but please expect students to write you first and to guide this relationship and not vice versa. However, if the team is not contacting you within a week, within one or a couple of weeks, please contact us so we can see what we can do. For the challenges, the main point of the challenge is to analyze the company and sell the story. And to analyze the company, the most difficult part is to understand the business model and the value chain of every company, then to distill it in a very short, clear presentation and sell it to the judges. To do that, teams are required to look at the top line, the sales growth, the margin, and also the CapEx. The most important part is that students tend to look at the history, and sometimes they forget or they omit the forward-looking assumptions and analysis, the main part of the challenge. So the main job of the mentor as well is to guide the thought process of each team to look into the future, but of course not to forget about the past. Some teams find it difficult to distinguish and understand the difference between a company and investment. Company can be good, but as an investment, it can be very, very bad. So also mentors tend to spend a lot of some time to help teams understand the difference and to package this in a very nice and neat story for the judges. For the graders, essentially, you'll be reading the reports anonymously, and your main job is to rank the reports of 3 to 5 teams. We will communicate this to you in the beginning of 2026. And the most important part is to remain consistent and to use the entire range of scores that is given to you. It's beneficial both for students, for us, and for the challenge if students per category can receive minimum and maximum points. So please avoid staying in the middle with just 1 or 2 point difference. Also, please write detailed feedback. We haven't had any problems, but as a kind reminder, feedback is appreciated both by the students and also helps them to improve for their future career, life, and if they're finalists for the next EMEA level. Final list of how we will allocate the mentors will be sent to you, let's say right after the kickoff, but before the October 13th. So please stay tuned. We will reach to you by the email. In terms of timeline, it's rather simple. The kickoff will be in the 9th of October in Zurich. Mentors are cordially invited to already to the award ceremony that will be happening on the 11th of February, and graders start their work in January. One of the important dates that we marked for the mentors is 5th of November 2025, when there will be a conference call with the company CFA. So one of the tasks of the mentor, if the team wishes so, is to help them prepare a question for the CFO. One of the rules that has changed or been modified from last year is the use of artificial intelligence. We received a couple of feedback from previous graders that they started noticing paragraphs written by AI. And the general understanding is that, first of all, it sounds unnatural. It doesn't represent the real work of the students, contains errors, and in some sense, it can even be considered disrespectful, as graders spend their time grading those reports and students just ask ChatGPT to write the research for them. So this year, there have been a couple of changes, is that students cannot misrepresent or attempt to pass their content, the AI generated content, as their own. They have to clearly mark phrases, paragraphs that has been generated by the AI. They have to disclose this. As graders, you can decide if you wish to penalize the team or just completely omit the paragraphs if you think they've been written to AI by AI. And also please notify CFA Society Switzerland, us, if you think that this is the case. However, students are allowed to use AI to help them with their research. That includes DCF modeling, multiples, just showing them the path, for example, how to approach or tackling certain challenges. So this is allowed, but writing the reports with the use of ChatGPT is not allowed. So finally, the subject company for this year is a very interesting company called Sika. Students will be presented and this company by their CFO at the kickoff by Adrian Widmer. So this will be their first interaction with the subject company, and the second interaction will be on the 5th of November with a conference call. Otherwise, students are allowed to contact and survey competitors, suppliers, customers, peers. That's up to them. Also, the website is considered public, so students can take any information or assets from the website. So without further ado, let's hear from Patrick, who will introduce this company to us.
Thanks, Mark. Hi, everybody. Always a pleasure to be on this call. Mark, you have to help me. What's most useful for you guys? Where should I start, right? I can start with the history. I can start with the general business model, product description. I don't know if I should assume a certain level of knowledge already on the company. Yeah, just give me some guidance how to best proceed.
Absolutely. I think the most important point is to understand the business model, the value chain, the drivers of the company, and also if you can give some, let's say not hints, but certain pitfalls that students can encounter when analyzing this company, so mentors can be aware of those pitfalls and try to help them avoid them or point them in the right direction.
Okay, good. Good, but maybe then still best to start quickly with just a brief introduction, right, on the basics. Then we go into the business model, drivers, and all the rest. So Sika, established probably around 150 years ago or so, not far from here in Zurich Altstetten as a hardware shop, but evolved naturally and with inorganic means into a global leader in construction chemicals. Not recently, right? They've been the leading company in this field for many years, but with a series of big acquisitions became ever bigger and have reached now a record level in terms of turnover, multiples, etc. Now, construction chemicals, what is that? It's not trivial to describe, right? The name says it, it's chemicals, it's chemistry. So you are typically mixing, formulating, or synthesizing in chemical processes certain materials that are then used on the construction site. But the exact formulations have thousands of variations, right? So SKUs are around 15,000, if memory serves me right. And also inputs, raw materials that they procure are running in the 10,000 ballpark. Because in the end, every single construction chemical is tailored for a very specific application and will have just a little bit of a difference in the formulation. If you talk about raw materials, just briefly, right? Typically, petrochemical chain, but several steps away from the cracker or the refinery, typically already processed materials, which means that the oil price move is an indicator for what's happening with their input costs, but only an indicator. It's never a perfect correlation. You have to go further downstream and then look at relative supply balances there to understand what's happening. And raw materials are not just chemicals, right? That's maybe 2/3. The rest is then a whole series of other precursors, including things like silicones for adhesives, especially, or even cement, right, for some types of mortars. The company is organized along target markets, building, finishing, adhesive technologies, and others, right? But all these categories, cements, concrete systems, just describe the type of product. The end market is almost always construction. Construction is about 85% of their business. The remaining 15 is what they call industry. And of that, 2/3 is actually automotive. But 85%, if we talk about Sika, it's typically construction. And construction chemicals are used where you need to improve, enhance, or alter the performance of basic structures or basic materials. I'll give you a few examples. To produce cement or concrete, depending on the application, high rise, humid environments, hot environments, cold environments, high altitudes like mining in the Andes, your concrete needs to have just slightly different properties. And in order to alter the properties of your basic Portland cement, you add admixtures, or then for the concrete additives. That's what Sika does. If you picture a huge kettle of cement, typically the Sika content will be a little cup of powder, right? Um, and and therefore the business is very much driven by application know-how rather than basic chemical research. That's done by suppliers like BASF, Evonik, all the rest, Dow, DuPont. What Sika does is purely application know-how, just figuring out a little bit of a better mix than an alternative product on the market. And that's a bit the beauty of the business model. Um, the If you think about the building project, whether you build a house or a commercial center, warehouse, factory, airport, bridge, tunnel, typically the content of construction chemistry is 1 or 2% of the overall investment volume for that building. So it's tiny. It's not driving up or down in any material way the total cost of building a house. But because of the massive range of SKUs that I flagged, right? For a builder, that's like 80% of the individual purchases he makes is construction chemicals, but it's not the high value content. And that's where we come maybe into the growth model or growth algorithm of Sika. The construction industry itself, globally, that's a general remark, is highly fragmented. Why? Because builders are usually locals, right? There's very few, if any, global construction companies or developers, right? It's always regional players, maybe national players, but that's it. Because regulation will be different. You need to know the owners, you need to know the architects, you need to know the supply chain, you need to know the plumbers, the installation guys, heating, whatever, right? These are all local businesses. I think we had Geberit once as a topic on this call, right? In Germany alone, there's 50,000 plumbing companies because your radius of operation is maybe, I don't know, 50 to 100 kilometers max. And therefore, construction is always very local. And that's why historically also construction chemicals was very fragmented and a local business. The fact that Sika has been performing so well versus competition is that they started 150 years ago. So by now, also thanks to lots of M&A, they're just by far the biggest, which means they have the biggest range of products. They have a highly professional service technician network. By service technician, I don't mean like for elevators, but they have technical support staff that are on the ground. If you go past bigger construction sites, very often you will see a yellow Sika lorry there, right? The guy is not selling stuff. The guy is supporting the builder locally, how to best apply all these different mortars, adhesives, bonding materials, sealants, etc., that he's using. And the fact that Sika is able to just cross-sell the entire range of construction chemicals that a builder might need is a huge advantage, right? Because he gets everything from one hand, and he doesn't have to bother with a massively complex supply chain for just a few bags of mortar or a few tubes of glue, right? And therefore, it's an industry that is by nature fragmented, but it's also an industry where by nature bigger companies tend to get bigger and better. There's a natural operating leverage built into this because you just absorb your central costs, especially around product development, much better. I used to be a chemicals analyst in my previous life, and in chemicals we usually say Commodity is like 3% R&D to sales. Specialty chemicals is between 5 and 8, and above that is then high tech, like really biotech type of stuff, enzymes, etc. So if you look just at this number, R&D to sales of like 2% for Sika is ridiculously low. It's actually lower than for base chemical companies often. But as I said, they don't have to do basic chemistry research. All they do is fiddle around with formulations, trying to find a slightly better one than is currently in the market. And in absolute numbers, if you look at R&D dollars, they still outspend the second biggest player by a factor of 2 to 3, which helps them to just stay ahead of the game. A very powerful business model, but it's also a slow burn in the sense that given the local nature of the vertical of the end markets, you you are also just very slowly penetrating the market. And that brings me to another important feature of the business model and the growth algorithm, which is M&A. Historically, for Sika, it was always a bit of a substitute, whether to go into a new region, a new country, a new urban area organically by building a mortar plant, or whether they just acquire a local player that has maybe succession issues or whatever to establish a footprint. So capex to sales, if you look historically, is also very low, 2-3% on average. But the real spend on growth is bigger because you have to include the bolt-on M&A, which in their thinking is a substitute for the capex. But this M&A strategy has just helped them to amplify the growth, which historically has been around 4.5% organic, by another 2-4% of M&A contribution. Normally, right, these are local businesses either adding a new product that they haven't had in their portfolio and can be rolled out globally, or establishing a footprint, as I mentioned. But normally, very easy, acquire a business, few million, integrate it, parachute in the Sika operations guys, get everything plugged in, and that's it. More recently, they've been a bit on a spending spree with two major acquisitions. One was Parex, one was BASF Construction Chemicals. And here we get a bit maybe into investment case considerations. These big deals help them, of course, to gain massive size, but they also torpedoed their capital returns, which used to be best in class for years. We're talking mid-20s ROIC. For a chemical company, it's absolutely top-notch. But they diluted this to, at the trough, 11%. Now we're maybe tracking around 14 because of all the balance sheet inflation from goodwill and intangibles, right? That's maybe something then for the students to decide whether that was value accretive or not. But if you look at the share price performance and why it's been such an absolute disaster since 2022, it's to a large extent, in my view, driven by that. Anyway, that aside, the other maybe important point here is if you look at the outlook or the current trading environment, right? Sika, the story behind Sika's own narrative is also not just about winning market share and establishing or filling white spots in their regional map. It's also a story about penetration of construction chemicals itself, right? Historically, construction chemicals grew maybe two times faster than the overall global construction spending, because the more complicated your structures are, the more you refurbish, the more you want to renovate, the higher value and higher quality materials you need. So there's been this driver, and Sika has argued that going forward, the penetration pace will double. Why is that? Building standards, a maturing um, building base in China, right? The big building boom is over, clearly. I mean, new build is collapsing, but existing structures are now getting into that critical 20-year age mark where renovation starts to kick in. Renovation materials are always higher value and need more technology than new build, which is more cement driven and more basic. And that's one of the, I think, critical hypotheses to test. Is it actually true or not? Right? The arguments are strong. Yeah, building standards are increasing. Every time you have a high-rise burn in Dubai or London, you will get more stringent fire protection regulation. Um, uh, Lots of bridges, tunnels are decades old and need to be refurbished. In addition, requirements for new infrastructure um, uh, projects are also massively um, different from where they were 50 years ago. Right, 50 years ago, the requirement when you build a tunnel was a useful life of 50 years, something like that. Now, the new tunnels in Austria have the requirements they need to last for at least 200 years. And to ensure that, you need to pump in much more technology, much more chemistry, right, to get that durability. That is sort of the equity story as presented by Sika. That's why they think they can outgrow even faster than in the past. But so far, or at least more recently, that's clearly not what we're seeing in the volumes, right? And that will be a bit of a make or break for the valuation, because the historical valuation was earned by capital returns being top notch, industry leading, and superior growth. Currently, we have diluted capital returns and no growth, right? So it's actually a very interesting point in time to discuss the investment case on Sika. Also, when you consider where the shares have been and what they've done year to date. Good, that's that. Maybe a few words on competition. There's one big player, that's Saint-Gobain. They've been buying a lot of assets. So in effect, everything that Sika didn't buy, Saint-Gobain did. And they're now clearly number two behind them. Then we have RPM in the US, but then it gets small, right? There's private companies like Mapei in Italy that are still active, but other than that, it's still very fragmented regional players, local players. Just for illustration, Sika's global market share is, I think, 12%, being by far the biggest by a factor of two, right, versus Saint-Gobain in this area. Um, that that's that. Customers, as I said, right, local business, local builders, architects, suppliers will be typically the big chemical companies. We know they're one of the biggest customers of Wacker Chemie in Germany for the silicones that they use in the adhesives. They buy a lot of stuff like plasticizers from Evonik, base chemicals, polyethylene, polypropylene from BASF. But it's, the usual suspects in that area, plus then other specialist suppliers for the individual formulations. Yeah, look, I'll pause here just to see any questions, or where do you need me to go next? I can also talk about the history, what happened with the management, the family ownership, if that's of interest. There's tons that we can talk about, but yeah, just let me know what's most useful for you guys.
Patrick, can you hear me?
Yes.
Maybe thank you very much for the introduction. Maybe a couple of questions. First is, do we have any correlation to the oil price, like any other chemical business?
Yeah.
And the second one would be on the failed takeover like 5-10 years ago. I don't really remember, but just to explain what's the current situation with ownership. Thank you.
With the ownership of Sika. Is that
Yeah.
the second question? Yeah. Yeah. So if I start with the ownership, it used to be family, right? There were a few family members going back to the own founding family that controlled Sika for decades via a dual share class. They held, I think, 20% or 18% of the capital, but 52% of the votes. And that, to a certain extent, right, provided also stability. The family was always conservative, only small acquisitions, don't be too aggressive. We also had Jan Jenisch more recently as CEO, now, right, of Holcim fame, who presided over 22 consecutive quarters of margin expansion. So, it was really a rock star gem in the Swiss industrial context. Also, maybe as a testament to the operating leverage. When I started to look at Sika back in 2007, EBIT margins were single digit, right? And the ambition was to get towards 10. And now we are on EBITDA, to be fair, but on EBITDA, we're scratching at 20. So the bigger they get, the more profitable they also become. And we think the story is not yet over, right? They can go towards 30 very long term. That's probably where we see in construction sort of a natural ceiling of what the industry accepts for a player to have. Good, but that aside, so we had the family always in charge, at least through the votes. Until there was 5 siblings from memory in the end who decided to sell. Right, they were all in their 60s or maybe even early 70s. No natural successor, and then the more fragmented the families get with the next generation, the harder it is to make decisions, etc. So they said, let's cash in, and Saint-Gobain appeared. That was 2014, right? It's almost it's a decade ago already. They decided they wanted to buy that controlling stake and get full control over Sika with just a minority of the capital. Of course, Revolt shareholders hated it. Everybody teamed up. We got Bill and Melinda Gates Foundation taking a stake. Capital came in, Fidelity. All of them tried to fend this off, fearing that, hey, Saint-Gobain, typical French, they'll centralize everything, right? And then Sika has to order pens and paper clips from Paris. They feared that the business model would be completely destroyed by this ownership. I'm not saying that's the case. I'm just sharing with you the sentiment of the time. So we had this extreme front, unified board management until Jan Jenisch jumped the ship, and investors unified against Saint-Gobain, against this takeover attempt. And that a legal battle ensured, right? It was pretty tricky back then because there were also change of control clauses, and you could actually restrict the voting, right? They had these voting rights restrictions in the clauses that the board can restrict voting rights at 5%. And the board said, hey, if you sell to Saint-Gobain, that's a change of ownership, we will restrict the voting power to 5, at which point Saint-Gobain spends all the money for nothing. The other side had the legal view that no, you can't restrict because the legal entity that has the ownership still is the same. Only the beneficial owner behind the legal entity changes. It was a whole thing. Anyway, legal battle lasted 4 years, never got resolved, but the parties eventually found a solution where Sika paid, let's say, a breakup fee of $1 billion to Saint-Gobain. The family agreed to, cash in and just sell the shares back to Sika, who then converted the shares into 1 share 1 vote and cleaned up the capital structure. And since then, it's 100% free float. So that's what happened on the ownership side. And maybe for understanding, right? It will be very hard for the students to get all this history, but what happened then? If you think back, that was 2018-ish. Interest rates zero. Growth still coming from the benefiting from the European recovery. China still going strong. Lots of growth. Money was cheap, and the control of the family, who always kept the ball low in terms of what they're willing to spend on M&A, right? Just do bolt-ons that are easy to integrate. They were gone. Sika enjoyed the cult status among investors after the successful defense against Saint-Gobain. Also keep in mind the zeitgeist, right? Back then we lost Syngenta to the Chinese. So people were very worried about foreigners buying all our top quality companies. And in that period, there was nothing wrong that management could do. And at that point, we had Paul Schuler running the company as CEO. He succeeded Jan Jenisch, and he was an empire builder, a textbook empire builder. You should include him in actually the books, the CFA books, right, on that subject. All he thought about was size, buying more and bigger. Money is for free. They financed Parex with 0.1% on a convertible. The equity conversion will happen in many years' time. Nobody cares. Plus, the share price will double. So, no dilution. It was almost crazy, I have to say, in terms of sentiment. But then, right, they started to overdo it. When they announced the acquisition of MBCC, also, sorry, I speak a bit faster. I try to get as much history over as possible. When the MBCC assets were former BASF Construction Chemicals, they were the top 3 player next to Sika. But unlike Sika, which was a pure play, it was always part of a huge chemical conglomerate. The asset was brutally mismanaged. Over 13 years of ownership, only 1% average growth, no margin improvement, but good assets, good technology, and a good brands in the market, because it's the former Degussa master builder business that was the prime competitor of Sika back in the day. So Sika didn't buy it the first time around. Private equity bought it. Lone Star from memory. And back then Sika said, oh, it's too expensive. We can't do it. And they were still digesting Parex. But then 18 months later, the asset came back to the market at twice the price. And then they bought it. And the market was still cheering everything they did. On the day of the announcement, that was end of 21, November or something like that. Sika shares were up 8% on the announcement of the MBCC acquisition. I put out a note arguing that, careful, if you run the numbers, I just get like a 4% ROIC on that investment. That's not even capital costs. I don't think this is financially a good deal, even if it's a good asset. I had hedge funds yell at me that I don't understand how the market works, because what I have to do is just take the EBITDA of MBCC, multiply it by the Sika multiple, and I create value, right? Helicopter money. So the market was still very cheerful. A few, let's say, even only 2 months later, interest rate cycle turned, January 22. Sika had assumed they can finance this thing like they did Parex with 0.1%. Didn't happen. They ended up financing at 2.5%, 3.7% with the debt issuance. Antitrust kicked in. They had to divest 30%. Half of the free cash flow contribution got immediately washed out with interest payments. And that's also when the cycle in terms of construction turned and volumes became a bit more anemic. And since then, it's been the greatest collapse from graces to just utter frustration amongst investors that I've ever seen for a former quality company. Anyway, So that's what happened with ownership. And now the first question, raw materials. We've done a lot of correlations. There's usually a time lag of about 6 months from when you see raw materials go up or down until it hits the gross margin at Sika, which makes sense. There's internal cycle times and lead times until shipment. But the correlation is actually pretty low. What's worked best historically is looking at a sort of a construction chemicals adhesives basket of all kinds of precursors, like benzene, like polyethylene. Look at what we took also MDI, all kinds of base chemical products that are used and silicones that are used in construction chemicals. And if you create an index, that index again directionally with a 6-month lead time predicts reasonably well where gross margins are going, but only directionally. It's very tough to calculate.
So Patrick, if I may, I would like to throw in another question.
Yes.
You haven't really mentioned anything about the industrial business and also the automotive part. Can you maybe also share your view on how this fits into this construction thing? Does it belong there? Is it different? Or how do you see it?
Yeah. The industry segments is a bit newer, right? I think they started with that maybe 25, 30 years ago. What they discovered was the same adhesives that they use in construction, you can actually use in automotive, but you get a much bigger margin, right? And that's how they entered. Then they were just looking for new applications, as they always do. Where can we use our materials? And back then they figured out, hey, the same adhesives we produce, we can just sell it to the auto OEMs, right? That is really actually the best comparable here is Emskemi, who do the same with the FTech division, where you just sell directly into the production line. Then you have these robotic arms, right? Applying sealants, bonding materials, and that's what they do. So essentially, how does it fit? It's just another vertical, but with exactly the same chemistry that they use in construction. That's why they have it. They used to report that actually also separately, always hiding the margin because it was too good to show to their customers. So they also historically they grouped it together with central costs. So margins were always negative, and now they stopped that, but they just included now the automotive or the industry business into they collapsed it into the regions. So it's 15%. It used to be 20, so it gets less relevant over time. But it's still very much core because it's just a different channel for the same materials that you anyway produce.
I probably have one more question. What do you see as the biggest catalyst for the company in the medium and
Yeah, I mean it's hard to just pinpoint one catalyst. It's right. Maybe worth sharing with you that there's a bear thesis in the market that gets a lot of attention, as evidenced by the share price. The bear thesis is the growth model of the past is broken. They will never again grow 7-8% per annum. They've become too big, right? With all these acquisitions, growth will be much slower going forward, and therefore the valuation multiples that the market was willing to pay in the past will never happen again, and therefore the shares are actually still relatively expensive, because you can find similar business models like Saint-Gobain that trade at much lower multiples but offer play on similar trends and exposures. That is the bear argument. And unfortunately, the only way to disprove that will be if Sika re-accelerates the growth. And here it's a bit tricky, right? Sika has only 11% global market share, but they are present in 103 countries. Geographic spreads across the continents is actually quite even. And they operate a total of, I should have actually mentioned that, that's important. They operate 400 plants, production plants, right? Because again, the radius of operation for a mortar plant is very limited, 100 to 200 kilometers, maybe 300. That's it. So I have a very dense site network. Asset intensity is low. Building a greenfield mortar site is a cost of 7-8 million, wherever you do it in the world. The revenue potential of that one site will be about 30%, 30 million with a 20% EBITDA margin. At peak, you can see, right, it's actually very high returns, very high ROIC business if you don't screw it up with big acquisitions. But anyway, if you are operating a business in 100 countries with 400 production sites, you are, to a certain extent, you cannot defy gravity. And if global construction is contracting by 3 to 4%, like currently, right? China is down double digit. US is struggling on the commercial side. Residential has been weak for a while. Europe is just coming out of a heavy construction recession, but we only see a bit of stabilization, no real growth. If you're in all these markets and your end market is down 3-4%, if you then deliver 0 to 1% volumes, that's still consistent with your relative growth algorithm, right? Outgrowing underlying markets by 4%. But versus published targets, which call for 6 to 9% growth, it's far off. And that's why the bear argument looks very compelling at this point. They're not growing what they should. There's no way they're going to accelerate to that level anytime soon. That puts at risk their intermediate and longer term targets. And therefore, we have the risk of a negative earnings revision cycle still ahead of us, a negative catalyst path, even if they have to revise down targets, right? They already warned on the guidance. Now they have to revise their targets. And that's why hedge funds are not touching this, right? Or if, then they play it on the short side. There's also tactics. The market currently favors heavy side, so cement, because of pricing and new builds and European infrastructure exposure. Sika is exposed to all of that too, but much less, right? If people want to play Germany, they buy Geberit because it's 30% of sales. For Sika, it's only 8%. So there's the case is a little bit broken from a narrative perspective, because disproving the bear argument, only time can fix that, right? But we need an acceleration, and therefore for the shares to, in my view, my personal view, for the shares to start working again, we need unfortunately not just self-help, but we need support from construction spending globally. It has to grow, otherwise it doesn't work. And then the next point is, what else could work for the shares? If, again, my personal opinion, and I'm not saying it's going to happen, but if you could convince Christian Buhl from Geberit to resign and take over at Sika, kick out Thomas Hasler, shares are probably up 15% on the day. And Geberit is down 10. But right, you need management style, management change. Management has lost all credibility. I'm hearing from even private wealth advisors telling me retail is giving up. we've seen large long onlys like Capital who've been invested for years with a big position selling down the shares. Yeah, it's a frustrating fall from, as I mentioned, right, from a company that used to be an absolute darling of everybody, and a company where, in my view, the quality is still great, right? I mean, what they're doing is still exceptional. They're still performing better on average than most of their peers. They are outgrowing global construction spending as they planned, but they're just running behind plan, behind promises, and they're in an endless disappointment cycle for now.
It will be interesting to see what students will come up with this year.
What will be interesting? Sorry.
In their analysis this year.
Oh yeah. And that you can approach this from all kinds of angles. Yeah. I guess what would be really interesting if somebody figures out an easy way for them to improve their capital returns. Not just, well, I don't mean top line growth and cost outs, or right. Is there a way to engineer the balance sheet, maybe identify where the goodwill is attached and do selective divestments, improve the balance sheet and streamline the invested capital? I mean, yeah, there could be some very interesting cases to be made. Yeah.
Thank you very much. If there are no more questions, we will move on to the closing remarks. So one thing that remains for volunteers, both graders and mentors, is to sign up if you want to receive the PL credits on the website. The link and the slides will be shared to you after the call with the recording, so you haven't missed anything. And especially for those who haven't joined the call live. The deadline for mentors is mid-October. For the graders, it's a bit longer, January 26th. And finally, for the new joiners, because we have many new graders and new mentors currently with us at the call, I've on purpose went a bit fast in the beginning for the presentation, because with the slides at the same time, we will send quite comprehensive handbook of a couple of pages, which explains everything, how to help students with presentations, reports, where to look at, what kind of questions can come up, how best to tackle the analysis. So this will be for you. You can read it and in your spare time at your own pace. Thank you everyone for joining. If you have any questions, you can contact the team that you see on the slide. Do not hesitate. We're always there to help. Thank you very much, Patrick, for this amazing and interesting introduction of the company.
Thanks, everyone. It was a pleasure. I have to run, okay? But good luck with the challenge.
We're closing the call. Thank you very much and good luck. You will hear from us by email when we will next connect you to the student.
Thank you very much. Have a nice evening.
Thank you.